Okay, let's get going. Hi, good evening, everyone. Welcome to India Karega Invest, our initiative to reach out to all of you on a weekly basis. Today, we are here with a very interesting topic and a very interesting personality. The topic is investing in international markets beyond FANG. To discuss on that topic, we have Mr. Kalpen Parekh. He's the managing director and the CEO of DSP Mutual Fund. He has little more than 2 decades of experience in asset management. So he has the complete pedigree is from asset management, and he's also known to be an awesome orator. So welcome back to the show, sir. We're really glad to have you here.
Thank you,
Uh, the
Karthik. Thank you.
the flow of the presentation is going to be that I'll start the session with a brief introduction about the topic, and then subsequently hand over the floor to Mr. Kalpen, and then we'll take up all the possible question answers. Please do post your questions. We would love to answer as many as possible. Okay. Uh, See, I think 2020 was the year when we started relooking at international markets in a very different way, specifically US as a market. The performance of FANG stocks and then maybe a couple of other stocks outside of FANG kind of really opened up our the way we look at international investments, right? These five stocks alone contributed to close to 25% of the total market returns. So you can imagine the enormous contribution what these five stocks made, and then that also made a lot of our Indian investors start looking at international investments in a very serious mode. But the question is, should we be just like limit our horizon or the way we look at international portfolios only to FANG, or should we look beyond FANG? There's a very interesting saying which I really love it, especially true when it comes to the matter of selecting stocks or sectors, or for that matter, even when you start chasing the best performing schemes, right? This year's a hot sector or a hot stock mostly may not be in that position in the coming year, right? I mean, that's a very interesting takeaway which I've really seen over last 16, 17 years or so. So keeping that in mind, then what are some of the areas what we could look beyond FANG as a category? Okay. Now, one is if you really look at tech sector alone beyond FANG, there are multiple emerging sectors or the sectors which are doing exceptionally well, be it at artificial intelligence space or Internet of Things, SaaS, semiconductors. And beauty of US markets is when you look at the largest companies of the world, they would want to get listed in USA as well, or US or global markets as well. So US markets also get that share of listing. So you looking at tech sector beyond FANG, by investing into these categories of companies, you are definitely taking exposure of not just US based companies, also companies operating across the globe, but they're listed in US. That's one perspective what you could look at. And then um, uh, just a couple of days back, IBIS had come out with their what's the outlook for 2022. What are some of the fastest growing sectors in 2022 in revenue terms? If you look at segments like airport operations, hotels and resorts, travel agencies, etc., because they've seen a muted performance in 2020, 2021, their revenue growth is expected to be 40% plus kind of a number in this year. Tourism airlines companies is expected to see 25% plus growth in revenue. When you look at the outlook by, say, Wall Street Journal or Bank of Am, they are of the view that movies and entertainment, especially pertaining to, be it in terms of, the theatrical releases or the OTT platforms, combined together should grow at a close to 37% CAGR till 2025. And oil and gas exploration and production. All these are some of the very interesting segments, which is other than the general IT per se, are doing very well or expected to do very well in this particular year, right? And then coming back to a very interesting and important argument with inflation. increasing, and US inflations are probably one of the all-time high levels in the recent past, if you see, with tapering or the overall what we say liquidity expected to coming down in the coming months. Should we be really looking at sectors like FMCG or utilities, the traditional sectors? So a lot of these questions are hovering on our mind. That is what is expecting, like let's say what Mr. Kalpen is here for, a perspective on what are some of the investment strategies we should adopt, not beyond FANG is what we should be looking at. Now, specifically why we should look at investing in global markets along with domestic markets. Three very distinguishing advantages. One, primarily diversification on your portfolio. Second, allows you to participate in companies which are not listed in India, but they're growing phenomenally well outside India. And third, very important thing, especially relevant for current times, protection from rupee depreciation. Right? I mean, if you look at historically, there are when you look at the relationship between Dow Jones and Sensex, some element of negative correlation is what you get to see in the performance or returns per se. Okay, but one very interesting anecdote, what I want to leave it here. 2013 was the year when, at least what I remember, where currency depreciation happened in the span of 3-4 months, and the impact what it had on equity markets, debt markets, even funds like liquid funds gave negative returns on a particular day in the month of July 2013, right? From 53, 54 rupees, the currency depreciated almost to 68 rupees against Indian rupee versus dollar. That was the time, if you see, um, from January 2013 till August 2013, whenever Indian markets did really bad, the US markets compensated it with the returns there. So at least during currency depreciation times, there are instances where global and US markets have done better than India and then provided the diversification benefit. So, how do we invest in international markets? We as Indians, retail investors, we could look at via feeder funds. So, we also call them as fund of funds. I think DSP is one of the leading fund house to introduce feeder funds. Way back in 2008, I remember launching Gold Fund, that was a feeder fund which DSP had launched there back then. So I think there's one more feeder fund coming in the offering, and there are other way of investing where you can invest in ETFs or active funds of those countries directly. So on that note, I would like to conclude my talk. I would like to invite Mr. Kalpen to take over from here.
Thanks, Karthik. Thanks for giving this backdrop. What I'll do is just talk about something which is very popular right now, which is very fashionable right now in recent times since the last year or so. And I'll also highlight that what is popular may not be profitable at times. So, as investors, how we need to understand these opportunities and the risk along with that is something that I want to share the next 15-20 minutes on. And then we can go deep into any questions and doubts that all of you as viewers and listeners have. So I just want to add to what Karthik mentioned, that when we think of investing globally, the names that come to our mind are typically the FANG companies. And when we actually take our mobile instrument and go to the screen time section, and I've done this many times, when end of the day I just am in my reflection mode that आज मैंने पूरे दिन किया क्या, gadgets पे कहाँ पे ज़्यादा time spent किया, did I really work, was I productive, or was it spent doing unproductive stuff? And I realize a lot of time is spent on many global companies and brands. So my instrument comes from Apple. My conversation with you today, from my perspective, is on a HP computer. Most of times these conversations happen on Zoom. When we look at our screen time, we have WhatsApp as one of the most dominated, mobile app which takes away all the time. We are known to spend a lot of time communicating using WhatsApp, exchanging information networking with people or conversing with people using WhatsApp. We spend a lot of time on social media, whether it is Facebook or LinkedIn or Instagram or Twitter. In my case, particularly, it's Twitter, because for me it is one of the best learning universities of the world, because I can follow anyone and everyone in the world who matters, and who is interesting for me. So, like day before yesterday, I was listening to a Twitter Space program where Chris Hadfield, who is an astronaut who has gone on many flights outside Earth, he was talking about his next book that he's writing and the real experiences which happened in space when he made his first space flight, and how people like Elon Musk, along with the agencies in US, are trying to think of interstellar travel and stuff like that. So there's a lot of interesting thing happening around the world. And we as a country are integrated today. We are a country nationally, but actually world over, all consumers are integrated purely because of a concept called technology. We are all networked. We know what's happening. So coming back, what is the connection of all this with money, with your and my hard-earned money? Ultimately, when we look at investing, what we have to look at is over a long period of time. When we buy, investing is nothing but buying businesses. I want all viewers to know, and a lot of you may have joined markets only in the last year or two, which has been a one-way upcycle so far, barring very short periods of correction. But most people think of investing as buying stocks and selling stocks, which is one style of investing. But really, the most profitable style, the most wealth-creating style of investing is to think of it as buying businesses and owning these businesses. And in a way, making the CEOs or the founders or the entrepreneurs work for you at very low cost or at very low fee structures. So today, when you buy in India, the largest market cap companies are companies like TCS or HDFC Bank or Reliance. You're making Mr. Chandra, or you're making Mr. Sashidharan or Mr. Mukesh Ambani work for you at very nominal management fees, and they are running businesses, they are creating profits, they are enhancing the return on equity on the capital and creating wealth for us. Now, when we look at components where our money today is really invested versus the rest of the world, and the most important variable in investing should be the operating metric called return on equity. It is a balance sheet metric of companies, which all of you should really look at when you buy companies, or what we look at when we build portfolios in our mutual funds. When we look at India, which is the proxy to India is Nifty, the top 50 companies of India. In the last 15 years, on an average, our highest ROEs were around 20% or so in the year 2006, 7, and 8. And they went down all the way to 9% between 2010 to 2018, 19, or 2019, in fact. And only post-COVID has profitability started coming back. So our ROEs have come back to 22. So the range of return on equity that the Indian capital market offers to all of us and to our money is between 9 to 22. It has been that range over the last 15 years. More or less will be similar over the next 15 years also. So on an average, 14 to 15% is the ROE that our capital in India earns. Most of us have most of our money in these companies. Then when you look at international markets, of late, in the last 1 year, a lot of prominence has come to international investing. While we launched our first international fund in 2008, we were probably 12 years early, because we were not able to highlight to our investors that what is the role and value that international investing can have in creating geographical diversification in our portfolios. It took 12 years to for this trend to really become relevant and people to start talking about international investing. So when you look at US markets, the replica of the top 500 companies, S&P 500, the ROEs are roughly around 15% or so on an average. And large chunk of that is coming from tech or innovation-led businesses. If you take them out, the ROEs of S&P 500 would actually still come down further. And then when you identify some of these innovators around the world, the tech companies around the world, not just from US, but from Latin America, from Europe, from Asia, in different parts of the world, the return on equity of these businesses in the last 16, 17 years has averaged between 14% in the down cycle and 36% in the upcycle where we are right now. So the primary point I want to make here is, today innovation has become profitable. Innovation is creating profit growth faster than traditional businesses, and the capital deployed in innovation is generating significantly superior return. In fact, many companies driven in the innovation space do not even need so much of capital, but because they can attack the global market pool, the market size for them is not one small city or one small state or one small country, but because of technology becoming being embraced by all of us around the world, the market size becomes the global market size. So that is why they are able to convert their capital into better efficiency and generate significantly superior returns, scale their products in a much faster way, have network effects, create strong entry barriers, create strong moats in their business, and then whatever cash they generate, they reinvest back in terms of R&D to constantly be ahead of the curve, to constantly disrupt other industries and become very dominant. So what Tesla is doing today, keep the stock price valuation aside for a moment. Probably the stock can still correct by 30, 40, 50%, who knows? But it has disrupted the entire automobile sector. In the last 5 years, Tesla alone has taken away a large chunk of the market cap of globally the entire auto sector, because of the threat of completely making the old-fashioned IC engine-led automobile businesses become redundant and move to the EV sort of future. So there are many examples like this in all modes. Zoom alone has disrupted what airline travel or hotels, because the need to travel and the need to stay for sake of business conferences or business trips has actually come down because connectivity has become completely digital. So likewise, Uber has done to mobility and car sharing, or what business models like Zomato or globally DoorDash are doing to dining and to the restaurant industry. Airbnb is doing to the hotel industry. So all of these companies, whether they may be profitable or not, in the future is a separate point, but they are taking away profits from traditional segments where we are all invested, which is reflecting in recent times in terms of their NAV growth. In the last 5-6 years, from 2015 to 2019, if you see here, the segment of companies or sectors which are investing heavily in innovation, creating very different business models, creating very different profit pools, the NAVs have grown by 32% CAGR in the last 6-7 years. I want to disclaim here, this does not mean that they can continue to grow at 32% or they cannot go down or they cannot lose capital temporarily. I'll show some slides on that as well. But in the last 6 years, this set of companies have become champion companies, and they have taken away a lot of profitability from others. They've created new profit pools, and that is reflecting in their ROEs as well as stock price performance. And likewise, funds which are investing in such companies are showing a significant jump in NAV. In the same period, Indian markets have grossed around 11% return. Now look at our capital, look at your wallet, look at your account statement. When you open your Groww app and see where are you invested in, large chunk of Indian investors. Today there are around 3 to 4 crore Indian investors investing in mutual funds. We all know that the last 2 years have seen a huge revival and resurgence in SIPs becoming the most dominant format of investing for all of us. The industry does around 13,000 crores of monthly SIP. 13,000 crores of monthly SIP means on an average, you multiply it by 12, 13 into 12 will be roughly 1,56,000 crores worth of inflow that is coming from all of us from our monthly SIPs. Of this 13,000 crore every month, 98% of that goes to buy Indian companies. It goes through all our mutual fund schemes into Indian companies, the top sectors like banks and software and industrials and consumer companies and NBFCs and home finance companies, auto companies, pharma companies, which are all traditional businesses. 2% money goes outside globally. And even what goes out globally does not completely go into the space of innovation, because of this 2%, half of it will go to the space of tech and innovation-driven investing. Other half will go to global traditional segments like gold or energy or metals and commodities. So the point I'm making is the profit pools are here, whereas our flow pools are somewhere else in our personal portfolios. And there is merit in all of you evaluating that, are your portfolios adequately capturing the big shifts that are happening in the world, the big profits that are getting created, the big new markets that are getting created, and the new champions which are dominating in that space. Karthik mentioned about FAANG, and I'll not speak much about this because they are well known today. They are a part of our life. We don't end our day, without probably buying something on Amazon or watching a series on Netflix or, being on Google to just search for answers that we don't know about. So they are well, known, well documented, reasonably popular. A lot of you would be buying them directly in your portfolios also. But that's one part only. There is a much bigger world when it comes to innovating, and that is what I wanted to highlight. And I just want all of you to be aware that there are smarter and better and more diversified and less riskier ways of diversifying your capital and taking advantage of the profit pools that innovation is creating. And I'll talk about 5 sectors, that I've given in this snapshot here. The plumbing for all technology, the plumbing for all innovation today that's happening in the world is happening through semiconductors. Today, you go to buy a refrigerator in Chroma, or you order a computer, or you buy your mobiles, or you today even go and buy a new age vehicles. Semiconductors are a part of our life. The way plastic has become a part of our daily life today, semiconductor has become a part of our life, and without semiconductors probably the world will freeze, because we all know how in the last 6-8 months the COVID crisis, the supply shock, created a shortage for semiconductor, and many companies could not ship their products out because everything digital today needs semiconductor. So every part of our life has some or the other semiconductor in it. And there are some very interesting business models and companies like Nvidia or Qualcomm or Intel or Taiwan Semiconductors, or so many of them which are dominant companies in this space. And this segment, if you had created a portfolio only of semiconductors over the last 10 years, it had done better than even the FAANGs. It would have done better than even Nasdaq. It has been one of the most steadily growing profit pool in the in all sectors in the world. In fact, yesterday I was reading somewhere that globally today there is so much of hype about semiconductors, which to some extent worries me. All global investment management companies, today every investment company will have analysts in healthcare, in consumers, in pharma, in banking, but there is huge shortage of analysts on the semiconductor side. And every fund globally with let's say $50 billion and above size today is seeking a telecom analyst. So that is the type of demand which is coming up. That is the type of froth also in a way which is building up in this space. And so while the opportunity is very large, but it is also in a way creating some sort of a bubble in terms of prices and valuation. Another space is biotechnology, beyond the traditional healthcare and pharma, which is what India is very well known for. India is well known for drugs and manufacturing of pharma. We are known as the pharmacy of the world. But when it comes to biotechnology, innovation and research in pharmaceuticals and leveraging technology in that space, there are very interesting business models like Intelia, Teladoc, Moderna, Intuitive Surgical. Intuitive Surgical is a company, by the way, which makes robots which are used for minimally invasive surgery. And 80% of surgeries that happen around the world uh, uh, using robots is where intuitive products are used. So they have 80% market share. And once hospitals and doctors get used to one product or one robot of a certain company, it is very difficult for someone else to come and replace it. So that's the type of moats that these global companies are able to create through their innovation and great products. There is a company called CRISPR, which is making a drug which is worth $4 lakh. One single drug is worth $4 lakh, and they are into gene editing. So today, in the space of cancer research, or in the space of identifying what is causing sickness in the human body, these companies are researching that it is which is the gene which is doing this, and if we can edit this gene, then in the next generation the edited gene will move ahead, and maybe these diseases will not continue to get transmitted into the next generation. So very interesting work which is happening in that space. Software is a space that we all know about, whether it is the entire ecosystem that Apple has built. Mobile is just an instrument, but it's basically an entire ecosystem that they've built through their iOS ring fencing. Whether it is Microsoft, Zoom, these are all software companies using software, through great codes and interface, where they are changing lives of their consumers. Then, media today, most companies who spend money for where all our expenses typically, if I give you DSP as an example, a large chunk of our marketing expense today goes to Facebook or goes to Google, because when we do search advertising, when we want to promote our concepts and ideas, we have to pay these companies, and they are becoming very dominant players in the media and advertising space. E-commerce is something that we are familiar with. We have some of these business models in India, like a Flipkart. But if you look at this slide, maybe not more than 3 or 4 companies in India can fit into any of these boxes. All innovation, in a way, which is relevant today globally, is happening outside India, and which is why we need to look at them. So, we classify, when we do our research about this whole space and how it is impacting various industries globally as well as in India, we look at them in 3 segments. Which are the companies which are dominant today? They are the largest in the market cap in their sectors. They are the largest in terms of profit pools or in terms of market share. So Tesla is not the largest in profit pool, but it is the most dominant company which will dominate the entire electric vehicle space. While other companies will gradually follow them and try to build their redesign their factories to or their technology, but Tesla is the most dominant company there. Apple today has the largest profit pool when it comes to selling gadgets like computers or phones. And now with Apple Watch, and they are also now testing self-driven cars and trying to think of different ideas. Look at companies like Adobe. There's no comparison. They dominate their entire market. Amazon, in terms of either shopping, giving you digital shopping experience and fulfillment, or in terms of cloud, whether it's Amazon or Microsoft, they are the 2 dominant players. 60 to 70% market share of the entire cloud in the world is owned by them. And likewise in streaming, you have Netflix as well as Amazon Prime as well as Disney Hotstar. So these are the dominators. But they were earlier disruptors. 10 years back, 20 years back, when they started with their business model or products, they were disruptors, and they succeeded at the cost of many others to become dominators. Who are the disruptors today? Today, the entire space of eating outside in restaurants is getting disrupted by companies like DoorDash. DoorDash is a Zomato equivalent of US, a much larger company, a more successful company, and much more cheaper in terms of valuations compared to what you find in India today. Take a company like Zillow. If you want to be here in India, you are in America, you've been living in US, you've come home for a long holiday, you want to buy a house there, you want to show to your family that in my locality what type of houses are available, and use their inputs to make a decision. Zillow will enable that for you. Zoom is known. Roku is a challenger to the Fire Stick that Amazon has created. So these are again iconic new businesses, but the risk in these businesses are they are very early in their cycle. They are loss making today, but they are growing their revenues at a very fast rate, and they are also growing the number of customers they are connecting, or number of consumers that are buying their products and services faster than anyone else. And for both these pillars, the most critical and interesting space, which is generally overlooked, which is also not seen to be most exciting, is the companies which enable either the dominators or the disruptors. They are the ones who are creating the plumbing for them. They are the backbone. They are the engineering companies, or engineering services companies, or engineering product companies which support this space. So Nvidia is one of the innovators in the semiconductor space. A company like EPAM is very interesting company in creating engineering products for semiconductor industry. Trimble is a company which creates engineering services for geospatial testing for irrigation industries, for mining industries, where companies want to create homogeneous land parcels, and they need technology involvement to do that. So these are companies beyond FAANG, and they are a lot of them are very profitable, very dominant. They have very high return on equity ratios. They have very high margins. They have pricing power, and they do not have challenges in that space. So it's very important that you as investors, when you start your journey of learning investing, don't just look at India as a market, but keep an eye on business models like this. And there are many ways in which you can do it. You can do it yourself, where you yourself are a fund manager. You do research today, data is available, and you can pick and choose companies of your choice. So that's an advantage of doing research yourself and picking these companies. Many platforms are available which have enabled global investing today. But then the flip side of that is operational efficiency is not the best at times. Taxation is not best. Cost structures are very high. Cost of conversion on buy and sell on both sides, typically for a retail individual investor, is much higher, versus when you do it through institutional formats like mutual fund, is much lesser. And the downside of picking individual stocks is, if you go right, you make good money. That's the upside. If you go wrong, you lose a lot of money. So risk of high volatility. On the other hand, the other choice of investing in some of these global trends is to buy passive funds, is to buy ETFs globally or index funds globally. The benefit is they are diversified. So if you buy a semiconductor index, you straight away get 30, 40 companies. If you buy Nasdaq, you straight away get 100 companies. But then with profit making companies, you also end up getting loss making companies. That is the downside of passive investing. With good companies, you'll also get the losers as a part of the package, though their weights will be smaller. And then you have to do a lot of homework to figure out of 1,000 ETFs which are there outside, how do you really pick and choose? The third choice is invest through global international funds. Ignore the word technology MFs. What I meant is global funds which give you access to a lot of these themes. There are good designs, better risk-adjusted returns because of mixing and matching of styles or sectors or even there are funds which invest in multiple global funds outside. So they mix and match the right strategies and style and keep rebalancing at different points in time. They can generate superior risk-adjusted returns. On the other hand, fund managers can also go wrong. They are human beings like you and me. So if they go wrong, that flip side is there. You have to pay the pain of that. And there are fees that you have to pay. So you have to pay 0.5% extra fee compared to the traditional way of investing. Now, so that can be the downside of using this route. So many AMCs offer global funds. We were, like Karthik mentioned, we started in 2008 due to our partnership with BlackRock. So far I've told you the good side of investing. Now I want to tell you the risk of investing. And I've just taken 4 examples which have been a part of our day-to-day life. Search engines. We all know of a dominant search engine, which is Google today. But what we don't know, or what we may have forgotten, companies like Yahoo, companies like Wikia Search, companies like Direct Hit, all of them were very dominant at that point in time, but they actually perished. So innovation has a lot of disruption in itself. While innovation creates new profit pools, innovation also creates, skeletons, by the way. Companies which cannot adapt, companies which cannot evolve, companies which cannot take advantage of changing consumer trends or technology trends get wiped out. When we look at emails, we started, but my first email address that I had created in 1998 was on Rediff and then Hotmail. But today I don't even remember. And these platforms, I don't even know whether they exist, whether it was America Online or Yahoo. They've become completely irrelevant. And again, Gmail has taken over that space. Social media, you have every few years someone becoming the hero, and then we get bored with it and a new theme becomes more popular. So Orkut was popular at some point, Hi-Fi was popular at some point, Google Plus was popular. Now a lot of them have become irrelevant, and today Facebook and Instagram and TikTok have become more popular. Likewise, in messaging, Hike or BlackBerry were very dominant. BlackBerry and Nokia, particularly in making mobile instruments, were very dominant. But today, they have become, some of them have just perished. And in messaging, WhatsApp has really taken over the entire world by storm. What are and which is why innovation can also be very volatile. And I want to just give you some examples. I mentioned about one of the pillar of innovation, which is companies which disrupt. So Zoom, in the last 18 months, massively disrupted traditional industries, traditional communication platforms during COVID times when we all started working from home. And a lot of us have got comfortable working from home. There are great advantages, apart from some disadvantages in terms of cost savings. But the stock price ran up a lot. And now, it's going through the other cycle of it. So, some of these trends will become popular very fast, capture imagination of the market, imagination of investors very quickly. Their stock prices rise faster than what they deserve to be, or higher than what they deserve to be. So Zoom will still be a dominant company maybe 5 years from now, but the stocks have run up. So I've taken example, the third picture here, which is ARK Innovation ETF. It invests specifically in disruption-driven businesses. Like largest weight will be a company like Tesla. Second largest weight will be a company like Coinbase, which is a exchange for assets and cryptocurrencies. Third will be
Yeah. Hi. I think there seems to be a small technical glitch at Kalpen's side. Probably we'll wait for a few seconds for him to come back. There seems to be a technical issue there. Um, the presentation is almost at the verge of ending. We will be taking up questions. There are a lot of interesting questions. What has come up, right from why should we invest in U.S. markets? How do we track it? And then how is it compared with China and so on? I think many such interesting questions. I think we'll wait to hear from Kalpen. Let's probably wait for a few seconds. In the meantime, if I can take up one or two questions from here, which are generic, not very specific to the fund. One question could be, what is the taxation for international mutual funds? The taxation structure for mutual funds is very simple and clear. The Income Tax Act defines or categorizes the entire mutual fund universe into two parts: equity funds, non-equity funds. Any fund with a like, let's say, exposure of 65% or less than 65% or less than that are categorized as non-equity fund. So when we say 65% exposure to where, Indian listed equities, and that investment should have done directly. So which means a portfolio of a mutual fund which holds 65% in Indian listed stock directly are qualified as equity funds. Anything other than that are called as non-equity. So because international funds, even though they are investing in stocks or shares listed outside India, because they're not listed in India, they're categorized as non-equity taxation, or the famous word what we use is debt taxation. So the debt taxation would be if your holding period is less than 3 years, which means you invest today. If you sell it within 3 years, anytime 3 years, the applicable taxation would be as per your tax slab. What we call it as marginal tax rate. Whatever is the highest slab rate applicable to you, that's what you would pay if you sell it within 3 years. If you sell it after 3 years, then it would be 20%. On the gains part, we call it as long-term capital gains. Then it is 20%, but with indexation. So what is indexation? You can bring up the cost of your purchase to today's date, and then you can pay the tax accordingly. Let me just see what are the other questions which have come. So, what are the major benefits and risks of associated investing abroad? I'm sure Kalpen also will throw some light on it. But my personal take, why somebody should invest in international markets, primarily diversification benefit. India is an emerging market. We ourselves are doing well. There definitely one should have exposure to domestic markets. But what we should not forget is, no matter how many funds you invest, which category of funds you invest within India, there is always something called as country risk. We call it as systematic risk that cannot be diversified beyond a point. So you want to reduce our India as a country specific risk, then look at investing in maybe gold and then maybe international markets. So from that point of view, international investing definitely gives us the portfolio diversification. But the disadvantages could be, other than the regular basic market risk what we get to see, the currency risk could be one like risk what we see. So currency risk could eat away into returns if doesn't work in our way. Okay, so this could be one of the key risks. Which what should we prefer? Should we invest in US stocks directly or mutual funds? See, I personally think, when you're looking at stocks, right, whether in India or outside India, there is a good amount of groundwork which needs to be done by an individual. Because when you're looking at investing in stock, we mostly look at the financial statements. We look at essentially the past of the company. But what is also important for us is to look at the future. What is the potential? What are the plans? And how much of growth is expected, what kind of market share they're expected to acquire. And then some of the other qualitative aspects like who is running the company, what are the competitive edge. A lot of these factors may not be very easy for a retail investor to really look at and then probably judge or take a call based on the information, whatever we just discussed. So, and adding to international market. So within India, getting information might be relatively easy, but investing abroad requires a different set of skill sets altogether. So at least from that point of view, it definitely makes sense if you were to go through an expert, we call it as fund managers. Maybe it could be you investing in ETFs directly, or you're going through a fund of funds or the feeder funds located in India or offered by Indian mutual fund companies. And let me just look at a couple of other questions. So when investing abroad, which sectors or industries should investors keep their eyes on, and which one should we avoid? I guess, okay, I think we have Kalpen sir here. I think we lost you there due to the technical issue. Welcome back, sir.
Sorry, I don't know when did I, get logged out, because I was only speaking to the screen, not knowing that till I got a call from Himanshu. So I was just concluding by saying that innovation is extremely profitable in the long term. It's a very prominent theme. These companies are not available in India, but it will be highly also have run up a lot because interest rates globally have come down, and as the interest rate cycle starts turning, a lot of these technology companies, which do not necessarily have profits in the near term, but their profits are more back-ended, will go through their own rounds of price correction. So as investors, just don't get carried away in the narrative. Like I was giving the example of gold rush, when gold was found in California in 1849, the miners did not make money, but the ancillary ecosystem of entrepreneurs who set up hotels, laundry services, newspapers to give it to the miners. The company which started making jeans, they were the ones which made profits. So just be conscious of the pros and cons of this space, and be a long-term investor. SIP is a very smart way of capturing the volatility that has just started. I gave you examples of how recently some of these sectors have started seeing price correction. And I think if you see that happen, continue for the next 6 months or so, it'll be very interesting to build portfolios for the next decade. Keep this theme as a very long-term theme in mind, and then take it forward. So thanks, Karthik, from my side. I think open to questions.
Thank you, sir. There are quite a few interesting questions. We would love to know your perspective. The first one being, there is a good amount of awareness levels which has been created towards international investing, especially over the last 2 years or so, or around 2 years. Now, from an individual investor point of view, how much allocation one individual should give to international funds or international portfolios from the whole
Sure.
holistic portfolio?
Okay. So, I think when we invest, we have to invest in what is good, not necessarily in a country, whether India or outside. Ultimately, what matters is, are we investing in what is good? So, if the best opportunities are outside, let it be 100%. If the best opportunities are in India, let it be 0. So, the truth is somewhere in between. What I'm trying to highlight here is the lens of global investing should not be seen as a separate lens. Uh, that it should be X percentage of my portfolio, but the lens should be the same as we apply to our businesses or to any business, which is this business unique? Is this business profitable? Just being unique is not important. Today, what is happening is globally in the space of innovation, what is unique is getting crazily priced. They are not making profits, but markets are giving them crazy valuations. So ask the question that whatever I'm investing in, whether I'm buying HDFC Bank in India or I'm buying American Express stock globally, whether I'm buying Infosys in India as a dominant tech company, or I'm buying Microsoft out there, which has a more diverse business model. Today, nothing in the world will operate without an Excel sheet or a PowerPoint or a Word or the cloud that Microsoft has made. So the question should be that, is the business model robust? Is the company going to create profits, today and in the future, more dominant than someone else? Are the ROEs rich? So, and then you contrast it to where our money is today. So when we look at our money today, when we look at Indian markets, the largest weight in India in Nifty, 33% weight goes to lenders. It goes to banks and NBFCs. They form a very large part of our investment universe. So when you're buying more and more of India, what you're getting is more and more of banks. Now, banks and NBFCs are basically capital intensive industries because their raw material is capital. When you take money outside to innovation or global markets, you're actually buying other sectors. So personally, in my portfolio today, I would have around 25 to 30% in global portfolios. But I want to add here is that I have invested in these when no one was talking about this, when they were very unpopular, when their last 5-year returns were very poor. So the next dimension to keep in mind, when do you start increasing your weights if you are underweight right now, is when they are not very popular. Today, the entire international space is very hot. It is very popular. It is at a 10-year high, almost at a 5-year high. So start building up your exposure, but through an SIP format. Don't go aggressive right now. Gradually, you build it up. And the third thing is, like you started off with saying, Karthik, I think your first comment was you gave example of 2013 and how when taper happened, emerging market currencies and our currencies also turned volatile. So a small advantage of global investing is if you are in dollar assets, these are all dollar assets. It hedges the 3% depreciation that our country, our rupee sees every year on an average. So typically what happens is we have 4-5 years where our currency is stable or stronger, and then we have 4-5 years when the currency depreciates. Normally, I will invest aggressively outside, counter cyclically. When our currency is very strong, is when I will take money outside, because then I will be able to convert, more rupees, and I would want to bring money back when our currency is weak, which means I can buy more rupees from the strong dollar. So be counter cyclical. So in the last 5 years, if our currency has depreciated, then increase more exposure to India, not outside. And hear my words again, be counter cyclical. So that's a smaller nuance, but the bigger nuance is good businesses outside. And lastly, so good businesses across India and globally, then what valuations, your currency cycle, and the third thing is valuation. So today, the challenge in India is, and of course, to some extent, earnings have come back in India, so valuations have normalized. But around till 2 years back or 3 years back, Indian markets were at 25 and 30 times valuations. Whereas companies like Apple and Amazon, Apple and Microsoft and Google, they were all at 15 times valuation. And they were throwing profits more than the market cap of some of the countries in the world. So great profitability, but underpriced. So just keep these 2-3 dimensions in mind to decide when to invest outside, but it should be a meaningful part of our portfolio, at least 20-25% over a period of time. Today, the cycle has moved a bit ahead and investors are a bit behind, because investors have jumped in international investing only in the last 2 years. Whereas this cycle started 8 years back. Exactly when you mentioned 2013 is when global NAV started moving up. So I think we are a bit late as a ecosystem, but never better late than never. And use SIPs to start building up. And whenever there are sharp corrections in global markets and Indian markets have run up, that is when you increase exposure to your international pie.
Great. I mean, a very nice way of putting it across. Just to pick up from the point where you left, sir, you did mention pick up things when they're weak. How about China then from that point of view? Things are not doing so well for China. Should somebody or could somebody have an exposure there as well?
So going by the philosophy that invest when no one is investing, and hence the market is very cheap. So Chinese market now for 13 years would have given zero return. And I'll just add a slight deviation here. Imagine the power of narratives. 10 years back, if someone would have told us that China will be the fastest growing country on earth, it will grow the fastest, and textbooks and the investment industry tells us that fastest GDP growth is the highest stock market return. And if you were told invest in only one country, then maybe all of us would have bought China, and 10-year returns for China is zero. So growth is not necessarily equal to market cap. because what price are you buying, what is the future outlook, and all of that becomes important. So China, I think, if you just go by the optics of data, by the valuations, and obviously a very dominant market, it has become reasonably cheap, and it might make money also, but it is still not forcing me to invest, because a lot of people who I talk to tell me that, can you hear? So today when Sundar Pichai announces results for Alphabet, you can attend them and you can listen to them at the same time as how a global fund manager is doing it, and you can understand, read, and interpret, and you can put it in your Excel sheet model. The same cannot be done for Alibaba or any of them, because you can't understand the language in the first place. And generally, China has been known for a lower transparency on many things. So those are the unknown risks in China. So I think my value thinking mindset tells me that yes, I would like to put some money in China, but so far I have not done anything. So how do I invest in China? I basically invest. So we have many global funds. So we invest in certain funds which are global investment managers, and they have presence in China, and they know the businesses in China much better than we know. They have Chinese analysts, Chinese fund managers who can interpret the quality of their accounts, whether their balance sheets are telling, their numbers are telling or not. So that portfolio may have 5 or 10% in China. So through that, I get some exposure. But directly, I have so far not taken that exposure, because my understanding of that ecosystem is very poor. The size of the opportunity is large. The price is cheap. These are two very good tick marks. But the question is transparency and ability to understand how they think. You can't analyze them. It is not an analyzable market, unfortunately, because of the language difference and the regulatory framework. So that is the only drawback of China. But I'm not the best expert to guide you, so don't take my answer with a pinch of salt.
Sure, great. The next question is related to DSP as a fund house, right? I mean, now you're come out with an NFO on Global Innovation Fund, which is a fund of fund, or essentially a feeder fund. I think one of our viewer has gone through the SEBI website and then seen your filing of NFOs. There are almost about, I think, 5 or 6 ETFs which are yet to come to the market. Any reason why it's only passive funds? What you're coming out with? What's DSP take? Why passive funds?
No, so actually it's not true. See, honestly, there is a gold, like there was a gold rush for mining gold in California, there is also an NFO rush. Like it or not, investors, if we tell them it's an NFO, there is more attention. We get invited to also speak about products. But if I say I have an old fund offer of a fund which was launched in 94, 95, which has done very well, no one will be interested to come and even listen at times. So we try to be balanced about it. We don't want to do an NFO just for the heck of it. Only if the theme is interesting and is complementing what we don't get in India is how we think of launching NFOs. So currently we are in the middle of NFO. We have launched a fund called Global Innovation Fund, and that is a fund which will invest in 6 underlying funds. 2 of them will be passive and 4 of them will be active. So it is not that we only want to do passive. We will do passive because there are investors who feel passive is good. We will do passive because there are times when passive does well. So there are times when beating Nasdaq is very difficult. There are times when beating the semiconductor index is very difficult. But there are also times when Nasdaq, when everything collapses, all the stocks in index will fall. But an active manager with a sensible stock picking format will be able to fall much lesser. So we believe in offering the entire range to our investors. My personal bias is I will always have a combination of active and passive. So we have a very interesting fund, which I think you should invite me to talk again for that at some point in time. It's called Value Fund, where 30% of the portfolio is invested in fund managers with value style of investing globally. And the largest exposure is Berkshire Hathaway. So Warren Buffett manages your money in a way, the largest weight. The second largest weight is Lindsay Train. So these are very interesting global managers. So these are all active managers. The current NFO is a mix of active and passive, but temporarily for the next month or two, because of some regulatory limits of overseas investing which are currently filled up. For the next few weeks, it will be in 2 passive strategies. But once those limits get enhanced by RBI, it is a matter of time. It will invest in active as well as passive strategies. The question that your viewer asked, some of our filings are for passive funds. It is true because there are some interesting ideas like the future of transportation. which will be a passive strategy where we will have two passive indices coming together. Then we have a fund called Energy Fund, which is an old fund of ours, but where we are completely changing the portfolio to only invest in companies which are working in the clean energy space, the renewable space. Now, this again is a very hot space. Prices have run up a lot. It will see huge volatility, but it's a great theme for the next 10 years. And at the right time, we will talk about it. It is an active fund. It's not a passive fund. So we have a mix and match of both. It's a combination of active and passive, where we find the need to have good managers, because some themes are complex. You need a good manager to identify them. There we go active. Some themes are well discovered, where a passive strategy can also make sense. So we'll create a combination of ideas and bring it to all of you.
Great. I think it's good to know that the themes are all different, and then I'm sure people would be eager to really know the different themes are in the offering. So the next question is the Global Innovation Fund. How risky is the fund from an investor point of view? Can we say this would be probably a type of a thematic fund per se, and then say the risk is relatively high, have a very small exposure to it?
Karthik, sorry, if you can speak a bit loudly and repeat the last two lines of your question.
Yeah, I was saying, how risky is the fund according to you from a retail investor point of view? Since it is talking about innovations, can we treat this as a thematic fund rather than the generic funds which are available? What's your take on it?
So let me answer it a bit differently, going to very fundamental principles. Forget the labels of large cap, mid cap, thematic, global, Indian. These are all labels.
Yeah.
There is risk in all equity investing, whether in India or outside, whether in large cap or mid cap, whether in growth style or value style, whether in thematic or non-thematic, whether in multi-cap or flexi-cap. Everywhere, broadly, the risk of investing in a business is the same. Number one. Number two, when I talk about the innovation fund, it is actually investing in companies which are impacting hundreds of businesses around the world in different sectors. So the sectoral outcomes are different. So there are companies in the biotech space, there are companies in the gene editing space, there are companies in mobility space, there are companies in communication, in software, in healthcare. So in a way it is diversified, but it is as risky as any other equity product. And to me, the risk is not, that. To me, the risk of this product today is that globally it is a very popular space. We as Indians are just discovering it. So, just that we have started liking global diversification doesn't mean these stocks didn't exist. They've been there for time immemorial. And like I highlighted in my presentation, a lot of these companies and their profitability is at a 10-year high. So it is not just the stock prices which fluctuate. Many times even profitability fluctuates. Many times margins of sectors fluctuate. So like because of the COVID, shock on the supply side, and the whole world was frozen for 1 year. Semiconductor shortages happened everywhere. So semiconductor prices have run up. So profitability of all semiconductor companies is at its all-time high. Now, can this remain forever? No, because what has happened now is governments are setting up large factories to manufacture more semiconductors. It takes time. It will take 2 or 3 years to set up world-class semiconductor plants. But when that starts happening, the supply will come back again, and the current peak margins will come down. So what is happening today is margins are at its peak, and prices are also at its peak. In the next few years, margins can come down and the prices can react. And to some extent, it has started happening. Like I showed you in one of the charts, the semiconductor index of the world is down 20%. So the volatility is getting reflected right now. Indian markets are down 7%, but this index is down 20%. So currently, the risk is where valuations have run up. I showed you the chart of the disruption space, which is proxied by our disruptive companies ETF. It is down 56%. Now, 56% is the fall that Indian markets had seen in 2008 crisis, GFC crisis. So this is the risk of any investing, and different sectors go through their cycle of risk at different points in time. They get hidden when the portfolio is diversified. So I think the space is volatile. I won't call it more risky than Indian market, because tomorrow if there is a currency crisis across emerging markets and our rupee fluctuates, even we will go through our share of volatility. But the only good thing that I feel, and which is why we are presenting the idea today, this fund was ready for launch 6 months back, but we delayed the launch because 6 months back it was closer to the peak of its cycle. In last 6 months, The aggregate NAV of the fund is down by 22%. So some froth has gone away. Some froth still remains. I'll be upfront about it. And the way to overcome this volatility is stagger your investment. If you do 120 installments of SIPs over the next 10 years, and if this whole correction gets over in the next 12 months, 90% of your SIPs will start after the correction is over. So the space is as volatile as any other equity market. It will have more uncertainty because it has been more popular. What is more popular generally will always have more volatility in times to come ahead.
Great. Thank you very much, sir. We wish all of you, very good luck with your NFO. Hope to, see the wealth creation journey staying strong there. Thanks for being here, and enlightening us.
Last comment, Karthik, I would say is that perhaps this will be the first ever SIP NFO in the industry. So we've actually positioned this as a SIP NFO because we want investors to, acknowledge the volatility and risk that a theme like this can have. So in a way, I'm just concluding your question by answering that the volatility is high and hence SIP is how we are recommending this whole item.
Thank you very much.
Thank you.
Thanks everyone for joining. Have a great weekend ahead. Thank you.
Thank you so much. Have a nice weekend, everyone. Bye. Are we done, Karthik? Can I log out?